Hey traders, what's the best indicator to use for a trading strategy? Is there a single best one, or a combination of indicators that will give you consistent profits? You may have 4 or 5 indicators working together in a strategy, but it still isn't profitable. So why not? These are questions I found myself asking all the time when I was first learning about trading. And I'm going to share the answers I found with you today. And by the end of this video, I'm going to show you how I use this knowledge to build a free and easy automated strategy that you can replicate that's given a 270% annual return in backtest. Later in this video, I'm also going to tell you how you can enter a $50 free prize giveaway as well, so keep watching till the end of this video to find out how you can enter. Let's dive in. When it comes to choosing which trading indicator to use, the key thing to understand is the type of indicator you're using and what it's looking to achieve. There are 4 general categories of indicators: trend following indicators, momentum indicators, volatility indicators, and volume indicators. Ultimately, if you're combining 2 different indicators from the same category, then it's unlikely that you're going to be adding additional value to your strategy. So how can we avoid this mistake? Well, we need to understand each type in more detail. Firstly, the trend following indicators. These indicators help traders to identify the direction of the prevailing trend in the market, so we know that regardless of short-term fluctuations, which general direction the market's moving in. Some examples include moving averages, either simple, exponential, or whole moving average, moving average convergence divergence, or MACD, or the super trend indicator. The key for trend indicators is to help us understand the likelihood of a short-term retracement or swing back in the price, and can help us establish whether we have the right conditions for the strategy we're trying to run. If you've seen some of my trading videos, you would have seen me put some rules into my strategies that look at the price in relation to its moving average, or look at different moving averages. When I do this, I'm looking to confirm the trend in the market. The second type is the momentum indicator. The momentum indicators provide insights into the speed and strength of changes, empowering traders to spot potential trend reversals, confirm trends, and identify overbought and oversold conditions. Examples might be the relative strength index, the stochastic oscillator, and the average directional index. I've done videos on a few of these, so go and check them out if you want to understand how each of them works individually. A lot of them will tend to oscillate within a bounded range, which means that we can put some simple rules in to determine the value and whether it's over or under where we want it to be. Divergences between price and momentum indicators can provide valuable clues about potential trend reversals or continuations. They offer early warning signs to traders, so the momentum indicators help traders identify extreme price levels in a range by telling us the relative strength or weakness of the trend. If we're looking to catch corrections and swings, then combining these with trend and volatility indicators can give us a powerful monitoring mechanism. Thirdly, we have volatility indicators. Volatility indicators measure the degree of dispersion or the variability of the price around a certain point. This tells us about the uncertainty in the market and how likely it is that the price could move up or down significantly in a short period of time. Some examples include Bollinger Bands, average true range, or a simple standard deviation. Again, I've done videos on these, so if you want, you can go and check them out. Volatility indicators typically plot bands or ranges around price data. These ranges expand and contract, i.e. they get bigger or smaller based on the market volatility. They help traders assess market risk. The higher the volatility means the bigger the possible movements, so we get these extreme swings up and down. Whereas when the volatility is low, we tend to get these relatively flat periods where not much happens. By knowing where we are in terms of volatility levels, we can make sure that we're setting appropriate stop-loss levels or identify potential breakouts or reversal opportunities. It's really helpful for us to make sure that we're timing our trades correctly when we're looking to enter or exit the market. Lastly, we have volume indicators. Volume indicators help traders assess the strength of price movements based on the trading volume. They can help confirm the validity of price trends, detect potential trend reversals, and identify divergence between price and volume. They're similar to momentum indicators in that they look to identify the strength of a trend. However, we're looking purely at trading volumes rather than price action. Volume indicators can tell us about market participants and the sustainability of price movements. If we see a divergence between trading volume and price, i.e. the volume of trading changes, but the price doesn't quite change at the same rate, then this can mean that there's a shift on the horizon. Because the whales and institutional investors want to maximize their returns, they'll use trading techniques. They'll want to minimize the impact that they have on the price, so they may be hiding the true size of their trade orders by drip feeding them into the market, so we can look out for big changes in trading volume with only a small price impact. And this will give us a good indication that there's potentially breakouts or reversals coming. It's called following the smart money. So we know that we've got 4 different types of indicators. Let me know in the comments below which one's your favorite, which ones do you use? Which one's the best to use? Well, the answer I think is that there is no one best. You have to find a combination that works for you, and I tend to find that the best results come from mixing the different types together. Make sure they complement each other rather than repeating the same information back to you in a different format. There's no value adding more than one indicator from the same category. Mixing them up is the most practical way of getting a holistic view of the market. Here's a strategy of mine that does just that. I'm not manually trading, I trade with automated algorithms on Arrow Algo. It's a completely free software you can build, backtest and run algo strategies, and you don't need to know how to write code. Just plug into your exchange account with an API and go for free. It's safe to use, it can only send buy and sell signals to your exchange based on the strategy that you've set. It can't withdraw your money from your account, and you can make sure of that when you set up the API. I'll leave a link in the description below. So here you can see the strategy of mine, and what do we have? We're ticking the trend indicator box by using the whole moving average, and checking whether the price is above or below the long-term HMA, so we know the general direction of the market is upwards. We have a momentum indicator here, with a rule looking at RSI, so we know that within the strategy we're entering at a point where the assets are in an oversold area. We have rules identifying where we are in relation to the Bollinger Bands, which makes sure that we're looking at price swings with an appropriate level of volatility, and we're at the low end of what we hope is a downward swing about to bounce back. Finally, we're using the on-balance volume to make sure that there's volume flowing back into the asset and that we aren't in a stale period with low demand. This strategy has taken me months of trial and error with different parameters, and I've made it free for you to download for a limited period of time. If you sign up to Arrow Algo, you can have this. Remember, I'm not a financial advisor and this isn't financial advice. Cryptos are a high-risk investment and you must do your own research because you could lose all your money. It's important that you thoroughly understand and backtest any strategies for yourself before running live. You can use this to learn and educate yourself though, and it could help you learn to build your own strategy. So there you have it. Time for another reminder of our $50 prize giveaway. Remember to enter the draw, you need to like the video and drop a comment down below, and we'll be doing the draw soon. Stay safe, happy trading, and see you next time.